Central banks play an important role in stabilizing price, output, the financial system, exchange rates, and interest rates. Their real power comes from the control over their own balance sheet and their power on the supply of currency and reserves. They can change the size of the monetary base by buying and selling assets such as government securities, which is also known as open market operations, make loans to banks, and adjusts mix of assets they hold.
Interest rates play a central role in all of our lives. They are the cost of borrowings and reward for lending and savings. Higher interest rates tend to restrict the growth of credit. This situation will make it harder to business and households to get financing. Furthermore, it also causes more difficulties for individuals to find and keep jobs. Before we discuss further about the interest rate use in the economy and financial market, we may first learn about the types of interest rates. First, let's start with the nominal interest rate. This is the rate that you'll often see quoted by banks and lenders. Nominal interest rate refers to the interest rate before taking inflation into account. Nominal can also refer to the advertised or stated interest rate on a loan, without taking into account any fees or compounding of interest. Next, we have the real interest rate. This rate takes inflation into account, giving a clearer picture of your actual gain in purchasing power. The formula is simple: real interest rate equals nominal interest rate inflation rate. So, if your bank offers a nominal interest rate of 5%, and inflation is running at 3%, the real interest rate is only 2%. How can we compute the cost of borrowing or returns from our savings from this interest information? For this purpose, understanding how simple interest works is essential, as it's used in a wide range of financial transactions, including some short-term loans and basic savings accounts. So, what exactly is simple interest? Simple interest is a way to calculate the cost of borrowing or the return on an investment based solely on the principal amount, which is the original amount you start with, whether it is money borrowed or invested. The key here is that simple interest does not consider any interest that may accumulate over time. It is simply calculated only based on the initial principal amount. The formula for simple interest is straightforward. Simple interest is equal to principal times the interest rate times the period for loan payment. The principal is the original amount of money invested or borrowed. The interest rate is typically expressed as a percentage, while the time factor is length of time the money is borrowed or invested, usually in years. Let's look at a quick example to see this in action. Suppose you deposit 1,000 ringgit in a savings account that offers a simple interest rate of 5% per year. Using the simple interest formula, the amount of interest to be received from this deposit will be equal to 1,000 times the interest rate 5%, multiplied with 1 year, you'll get 50 ringgit. That means, you'll be receiving 50 ringgit interest from this deposit by the end of year 1. What about in the case of loan payment? Suppose you have borrowed 10,000 ringgit at a simple interest rate of 8% per annum. In this case, assuming that the loan is to be repaid in 3 years or equivalent to 1,095 days. If the interest is compounded annually, the total amount of interest to be repaid after 3 years would be equal to 10,000 multiplied by 8% times the 1095 over 360 days, you'll have 2,400 ringgit interest on this loan. By the end of 3 years, the total amount to be paid on this loan is 12,400, which covers both principal and interest amount. Now, let's go over 5 key factors that influence interest rates. We are going to discuss 5 factors in this lesson, which include inflation, real interest rates, default risk, liquidity risk, and time to maturity. Let's start with inflation. Inflation refers to the general increase in prices over time, which reduces purchasing power. When inflation is high, lenders and investors need higher interest rates to compensate for this decrease in purchasing power. For example, if inflation is 3%, lenders might demand an interest rate above 3% to ensure they're not actually losing value over time. As inflation rises, interest rates tend to increase, and when inflation is low or stable, interest rates often decrease to promote borrowing and spending. Next, we have the real interest rate. The real interest rate represents the rate of return on a loan or investment after accounting for inflation. As mentioned earlier, unlike nominal interest rates, real rates focus on actual purchasing power. For instance, if the nominal interest rate on a savings account is 5% and inflation is 3%, the real interest rate is 2%. This 2% is the true gain in purchasing power. Generally, when the economy is growing, real interest rates tend to be positive, encouraging investment. But during economic downturns, real interest rates may drop, as policymakers might lower rates to encourage borrowing and stimulate the economy. The third determinant is default risk. Default risk is the risk that a borrower won't be able to repay a loan. Lenders consider this risk heavily when setting interest rates, because higher-risk borrowers typically lead to higher potential losses. To compensate, lenders charge higher interest rates to borrowers with high default risk, such as those with poor credit histories or unstable income. In contrast, those with low default risk, such as government bonds, usually have lower interest rates because they're seen as safer investments. Moving on, let's discuss liquidity risk. Liquidity risk is the risk that an asset can't be quickly converted into cash without significant loss in value. Loans or bonds that are easy to trade, such as government bonds, have lower liquidity risk and therefore, lower interest rates. However, assets that are hard to sell, such as long-term or specialized loans, carry higher liquidity risk, meaning lenders might charge higher interest rates to compensate for the difficulty in selling the asset quickly. Finally, we have time to maturity. Time to maturity refers to the length of time until a loan or bond is due to be repaid. Typically, the longer the time to maturity, the higher the interest rate. This is because, over longer periods, lenders face more uncertainty, such as changes in inflation, economic conditions, and even default risk. This leads to what's called the yield curve, where longer-term loans or bonds usually carry higher interest rates than short-term ones to compensate for this added risk and uncertainty. Next, I am going to talk about two types of interest rates you'll encounter often when borrowing or investing. These rates are called fixed interest rates and floating interest rates. Each has distinct advantages and disadvantages. By understanding them, it can help you make smarter financial choices. Let's start with fixed interest rates. A fixed interest rate remains constant throughout the loan or investment period. Whether it's a personal loan, a mortgage, or a bond, a fixed rate means that the interest you're paying or earning doesn't change over time. This stability is a major benefit, as it allows borrowers and investors to predict their payments or returns accurately. Fixed rates are popular for mortgages or car loans because they offer peace of mind. This is because, with fixed interest rates, borrowers know exactly how much they'll owe each month, regardless of fluctuations in the economy. However, one downside is that fixed interest rates are often higher initially than floating rates, especially when rates in the market are low. Lenders charge this premium because they are taking on the risk of interest rate changes over the loan term. Now, let's talk about floating interest rates. A floating interest rate, also called a variable or adjustable rate, can change over time. These rates are typically tied to a benchmark interest rate, like the overnight policy rate, OPR, or the base lending rate set by central banks. When the benchmark rate rises, floating rates also increase, which means borrowers may see their payments go up. Conversely, if the benchmark rate falls, payments decrease, benefiting borrowers. The key advantage of a floating rate is flexibility. When market interest rates are low, borrowers with floating rates can enjoy lower payments. However, the main disadvantage is unpredictability. If the benchmark rate rises sharply, borrowers may face much higher payments than expected, which can affect their finances. Next, let us understand how Bank Negara Malaysia, BNM, influences interest rates in Malaysia and how these changes affect our economy and daily lives. As you may know, interest rates are more than just the cost of borrowing or the return on savings. They're a powerful tool that can impact spending, saving, investing, and even the strength of our currency. BNM uses a primary tool, called the overnight policy rate, or OPR, to influence interest rates. This OPR serves as a benchmark for short-term rates in the financial system. So, what exactly does BNM do with the OPR, and how does it affect all of us? BNM reviews and sets the OPR based on Malaysia's economic conditions. When the economy is growing too fast, inflation tends to rise. To curb this, BNM might increase the OPR. Conversely, if economic growth is slowing, BNM might lower the OPR to stimulate spending and investment. How does changes in the OPR affect our daily life? Changes in the OPR directly affect the rates that banks charge each other for overnight lending. Interbank lending happens when one bank borrows from another bank. When BNM raises the OPR, these interbank lending rates go up, and banks have to pay more to borrow. This typically leads banks to increase the rates they charge customers on loans, mortgages, and credit cards. So, borrowing costs go up, and people may think twice before taking out new loans, which can help reduce overall spending and manage inflation. When borrowing costs increase due to a higher OPR, it can reduce spending on big purchases like homes or cars, and it can also slow down business investments. On the flip side, if BNM lowers the OPR, borrowing costs fall, making loans cheaper and encouraging spending and investment. So, this rate adjustment affects everyday financial decisions for both businesses and households.